So to shift gears and talk about this and how this is impacting, the venture and private equity ecosystem across a couple of dimensions. So at the highest level, how do you think this is changing the VC and PE business model in terms of, like you just said, adding a strategy that differs from the traditional fund model? And then and then to push that question a little further, SPACs compete directly with VCs, especially with growth equity investors. So do you think there's room for both formats?
Yeah, I think it's fair to say that there's going to be a meaningful impact to the venture capital ecosystem. And that's a sentiment I think that the vast majority of venture capital and private equity managers we speak to and invest with at Fairview echo. But we should return to the numbers for a little bit. We know that there's a large pool of undeployed SPACs waiting in the wings. Approximately $75 billion in SPACs was raised in 2020. By rough approximation, those SPACs typically absorb companies 5 times their size. So that result equates to about $375 billion in buying power for these SPACs. And that's just a staggering number. To put that in context, that's more than all the US private equity and venture capital firms raised in all of 2020 combined. So that's just sheer volume alone suggests there's going to be an impact to the venture and private equity ecosystem. But you turn to the supply side, and we've had discussions with many of our managers, several of whom have either exited companies to SPACs or raised SPACs themselves. And there's starting to be consensus on what constitutes an ideal SPAC target candidate from a company perspective. It has to have a great story. It has to be in a visible market sector, a strong management team that's IPO ready, that can present well to public investors. It typically has to have reputable VCs in the syndicate, good customer validation. It needs to require significant capital, usually over 100 million in the near term, and is willing to take on that dilution. And it needs to determine that it's going to be easier to raise SPAC capital than it is to raise private markets capital on better terms. So all that is to say, you put that together, and the universe of investable SPACs is significantly smaller, in my opinion, than the SPAC capital that's looking to find these targets. And so what does that mean for the venture ecosystem? Well, if you were an early stage investor, this is great news. You've got a broader universe of acquirers than a year ago. They're willing to come in earlier than when a company's traditionally exit ready. And so you just have this new path to liquidity that complements the IPO and direct listing options that you've had. Now, if you focus on the later stage in venture, you can start to find yourselves competing with SPACs, particularly when it comes to the highest quality assets in the market. And so that could reduce the universe of investable opportunities that you have. Or at the very least, it forces you to deal with companies that now have different valuation expectations than before. And that can be a challenge. I think the best late stage venture funds will navigate this successfully. Some are likely to struggle, and some opportunity funds are likely to struggle as well. But all that assumes that they don't evolve. And I think many will evolve very quickly. I think the easiest path of evolution is for some of these late stage funds to become SPAC sponsors themselves. Really going out and sponsoring SPACs and holding those interests in their late stage funds, which is an attractive area to be in. And we're starting to see some of those signs occurring.